Before we start, let's state our disclaimer. Tonight's webinar is purely for educational purposes and shall not be relied upon as investment advice and acted upon. We will try our best to present the information as accurately as possible, and we shall not be liable for any investment losses due to any inaccuracy of the information presented. Investors are advised to do their due diligence to understand the product nature and features, the risk, as well as whether the product is suitable for you before investing into any financial instruments. Hi, good evening, everyone. I'm Colleen. Thank you for joining us on a Tuesday night. We are great to have you here. In this webinar, we will be sharing with you how to achieve better trading results with proper money management techniques. And this section is brought to you by CGS-CIMB Private Wealth. At CGS-CIMB Private Wealth, we align our expertise in investments and wealth management to your unique financial needs. We offer an integrated suite of financial products and personalized service, and we will grow with you through your investment journey. With more than 40 years of experience as the Asia's leading financial gateway, we understand that every client has different financial goals that require comprehensive financial solutions. We have a very strong investment committee based in both Singapore and Malaysia, backed by award-winning research team, and we also develop our own asset allocation models from years of researching and testing. Our product suite includes equities, fixed income securities, derivatives, mutual funds, structured products, and a lot more to come in the near future. Very recently, we have also launched the discretionary portfolio management service that offer both the customized mandate as well as the standardized solution to meet our clients' investment goals. Enough of all the introduction. Let me now introduce our speaker for this evening, Damien Chow, Portfolio Manager from the DPM team. Jake has been with the firm for more than 10 years, starting out as equity advisory and sales. Subsequently, he moved on to the CGS-CIMB research as a market strategist, where he pioneered the development of the firm's proprietary CQM dual momentum trading models. Now, he has joined the Private Wealth Division as the portfolio manager of the DPM team. So in this session, Jake will share with you some of the risk management strategy that you can also apply as a frequent trader in the market. During the session, if you have any questions, do not hesitate to type them in the Q&A. We will do our best to answer most of the questions after Jake has finished his presentation. So without further ado, let me now hand the time over to Jake and invite him onto the program. Jake, over to you.
Thank you, Colin. Thank you so much for your introduction. And let's start the night with a quote from Professor Edward Top, one of the guys that I respect a lot. And this is what he says: if you bet too much, you'll almost certainly be ruined. And Edward Top is a renowned mathematician. He's a very active blackjack player and an ex-hedge fund manager who's posted one of the lengthiest and the best investment track records in all of finance. In the 210 months of investing, he had just 3 negative months, and all were 1% or less. And during his 29-year career, he delivers an annualized return of 20%. And Top is the author, Beat the Dealer in the 1960s, and most recently, the book title, A Man for All Markets. He is also the one who created the first wearable computer in the 1960s to predict where the roulette ball would land, using Newtonian physics, and even Hollywood made movies about his card counting techniques. like the movie 21. And in this session tonight, there are 4 key points that I would like to cover. Well, first is to identify a high probable price target and stop loss, as traders are not like investors, where holding short periods, where traders hold shorter periods than investors, and therefore you need to be able to be more accurate and establish quantifiable price targets and stop losses. And second point would be calculation of risk and reward ratio to find a better trade. So with the ability to calculate your risk reward ratio, you can know what is your potential upside and downside. If you do not know that, it is possible that your portfolio could go down 50%. And when you're in that situation, you need to recover 100% to go back to your original position.
Sure. Hey,
And
Jake, you may want to share screen with the audience.
oops, sorry. My apologies.
No worries.
Okay,
Okay.
so yeah, the third point that I would like to cover is how to determine the optimal position sizing. Position sizing goes hand in hand with your risk reward ratio. And of course, I'll take you through the step-by-step process to work towards that. And the fourth point would be to manage your risk effectively within your trading portfolio. And I'll share with you guys how to mitigate your overall portfolio risk, especially when you're not trading well, right? This is especially more so if you're using leverage. Just a word of caution, professionals usually use between 1 to 3 times leverage on equities. And more often than not, retail investors or traders, they use 5 to 10 times leverage. So one should really learn how to manage your risk type so that you have your ammunition to stay in the game. Well, we'll start first with identifying high probable price targets and stop losses. There are 3 common ways to project or forecast technical price targets. The first would be the height of the established trading range, which I use a lot. In this case, a lot of technical traders, they will quote your head and shoulders, your triangles, ranging from descending, ascending, symmetrical triangles to rounding top, rounding bottoms. That's your very commonly used way to finding your price target. Second would be your previous major support and resistance levels. I use it a lot myself. So these are very commonly used methods to project. Third would be Fibonacci levels. I don't use it that much, but a lot of traders in the market do use it because for my own experience and research, I realized that a lot of the Fibonacci levels are resting on major confluences of your support and resistance. So I tend to not specifically use it, but I just on and off, I'll take some reference from there. But if you're able to identify major support and resistance, and even your ability to use a lot of your technical indicators or your patterns, it's good enough. And of course, moving on to 3 common ways to apply a stop loss. The most common way is to apply a static stop. Usually traders apply it upon your entry. What you do is you usually put a few beats below your previous 5 or 10 days significant low or a major support level. One note to share with traders is please avoid round numbers because it tends to cluster around those areas. So I would usually not use round numbers for my stop loss, but some odd numbers. Second would be trailing stop. it is quite common as well, especially with the more active traders. So what you do is usually after entry, you will tighten your stop, your static stop when it starts moving in your favorite direction, whether up or down. So some traders use parabolic stop and reverse. Some people use Bollinger Band as a gauge or a reference. Some people use ATR, average true range, or some people use the 20-day, or could be 5, 10, 20 days exponential moving average as a reference point. I personally use a lot of Bollinger Band, ATR, 20 days moving average. Those are very common methods of knowing when to apply a stop loss. And of course, the third one is the least common is a time stop, right? You have a rule that says I get myself stopped out if, let's say, my positions are not moving 4 to 8 weeks, or it's within a very tight trading band. So if your trades are not productive after a specific time period, get yourself stopped out and channel your trading capital to better productive trades. And tonight, I will focus a lot on this particular chart. This is a 1-year price chart of Apple. On the left-hand side, you will see the chart starts somewhere in August, September. This is a period where it starts to rally. If you can see over here, right, this is a major resistance turn support at $55. So you can see price action starts creeping up against the resistance and breaking above it. So we will start tonight's practice or demonstration by using this particular chart and using all the available data. So in order to establish a price target, what we will do is we will use the low of here, 55, and a high of this trading range, 81. So this is the height of our trading range, right? So we can see after breaking out, price tends to rally, correct itself, and in this case, it broke 200 days moving average, but it recovered, right? So in this case, the trend is intact, the long trade is intact. What you need to do is to establish your price target if this price resistance is being taken out. That means the price breakout from here. So what I'll do is I'll take the height 81 minus 81 minus 55, and you get 26. So if there's a breakout from here, I will project this number up. So I will project a 6 up towards here, right? So I'll project from 81 onwards. But in this case, that's just my style. I discount 0.5 from the price target, so that it acts as a buffer because I want to avoid a round number. So in this case, your price target 1, it's 106.5, right? You can see adding this thing up, my price target is 106.5. So this is usually where I'll take some profits off the table when my trade is on and it hits where I am anticipating resistance to occur. And indeed, this happens to be a major resistance point. So I will use this as a pivot for potential trades, and also somewhere I can profit if I want to make sure that I'm not too aggressive, or I'm happy with, let's say, a 20-30% gain. So this is a very good reference point. As for stop loss, what I'll do is, if you look at here, I use the low of the previous 2 weeks as a reference point. In this case, it's 75. And my style is usually I'll mark down a bit as a buffer. So in this case, I mark down 0.4 or 0.5. And I've established my stop loss at 74.5. So once we have calculated our price target, we have established our stop loss, we will move on to calculate our risk reward ratio. And in this case over here, the risk reward ratio is your price target one minus your entry price. So I assume the entry price to be $1 above the resistance at 81. So I'm taking 106.5 minus 82 and divide by my stop loss of 750. And you have a risk reward ratio of 3.27. Pardon me for the typo over here. It's basically 3.27. So using this ratio as a reference to compare and evaluate other potential trading opportunities or trading positions out there, you would want to compare and see which trade, whether you're on or potential trade, offers a better risk reward ratio. Because you want to allocate your money to trades with higher risk reward ratio in excess of 2 or 2.5, 2 and 2.5 and above. Usually traders would reject anything below 1.5, right? That means you're risking $1 for every 50 cent that you're you're risking $1 for every additional 50 cents you're trying to make. So that's not very ideal mathematically for professional traders or even for serious traders. That's not quite ideal. So the ideal number is 2 and above. So that means I'm risking $1 to make 2, right? So that makes more mathematical sense. And moving on to the second leg of this trade, using the same method, we will calculate the price target by taking the height of this previous trading range. So what you see is 106.5 plus 25.50, the height of this range. The height of this range, and you will get a price target of 132. The risk reward ratio in this case is very easy to calculate once you have the price target. So it's 132 minus 107, which is your your entry, right? So I'm assuming entry at 107.5, divide by the stop loss, which is $7 in this case, and you get a 3.5 risk reward ratio. So this again is also an acceptable ratio for a lot of traders. So if this resistance level is being taken out and it breaks out from here, a trader would want to establish a trade on that. And true enough, price did break above it. You can see the subsequent price action reached its price target very fast, 132. Right? So some traders who, depending on yourself, some traders would want to take some profit, some would not, right? So, but bearing in mind, this particular move has been quite extensive, and from time to time, you can expect some correction back to its 50 days moving average over here. This blue line is just 50 days, and this is usually what I consider a meaningful correction or a pullback. It don't really threaten the stop loss. Is hardly ever near its 200 days moving average. So it moved very fast, it corrected very fast, and it hangs around for a couple of months before it starts to break out from here, right? So this price action, after it play out, you want to project the next leg upwards. And same thing by using the method I've shared previously. So we calculate the price target by taking 132, right? That's the resistance of your descending triangle over here. In this case, you see that I use a different method. I see a descending triangle. I use the resistance level as a reference point, right? So I take the height of this triangle, which works out to be 145 minus 113. That's 32. Right, so I use 132 plus 32, I get 164. So that's the next price target for the next leg up. And we can also work out the stop loss from here and the risk reward ratio. So the stop loss is this particular region over here, right? The reason why I picked this stop loss is I'm using, in this case, the 200 days moving average. It's roughly about 135, so I'm using 134.50, right? So as a trader, you need to be flexible enough to use certain scenarios, certain tools when the situations are different, right? So all this works out to be your risk reward ratio works out to be 4.27. So if any trader waiting or anticipating for a breakout over here, he or she must be doing all this calculation way beforehand to anticipate and to project what kind of risk reward ratio when indeed it happens. So of course, in this webinar, we're not going to cover on stuff like methodology and your psychology for trading. It's risk management, right? So we won't touch that, but in this case, you have to learn to manage the downside risk by doing all these calculations. If you don't do it, you're not prepped for it, and you are not able to handle unforeseen circumstances. Right? So assuming you're a breakout trader, and when price action starts breaking out around here, $81, $82, and right now, Apple closed at 146.09 yesterday. If you took profits entirely over this region, right, at 106.5, right, you still make a decent 29.8% or 30% returns for a good couple of months straight, right? It's roughly about 3 months over here, right? So breakout, take some profits around here. 30% gains are pretty good. And if you take long positions at various breakout points, that means I long here, take some profits here, or I totally take all my profits here, and I re-enter based on breakout. This breakout, what your experience is, you are still sitting comfortably on gains by trading like that, right? I won't be stopping you or telling you what is the right way to trade. It really depends on your personality and your preferred method. So the gist of the story is, no matter what style of trader you are, you consistently practice tight risk management. You have rules for entry, exit. You are very likely to be riding the trend. And of course, if you're a typical trend trader like me, you are likely to let your winners ride longer, and you could be sitting on 78 or 80% gains by now. So moving on to okay, so after we've done all the calculations, you would need to find the last piece of the puzzle. In this case, determining your optimal position sizing. Oh, sorry. In this case, the second last piece, right? So how do you determine your optimal position sizing? Oops. Right. Generally, there are two simple methods of doing this. In fact, there are more methods, but I am just presenting two simple methods. In this case, the first would be based on max loss per trade, and the second is based on the volatility. Right. So based on using the previous example over here, you have a portfolio of $200,000 in trading capital, and you're risking 2% per trade. Right. These are quite standard. You can Google and you find out the recommended trading position. But let's just stick to a textbook 2% risk per trade. So based on the maximum loss per trade, what you're trying to do here is you're taking your entry price, your stop loss at 74.50 and your target price of 106, using all these numbers that you predetermined, right? The formula is very simple. You are taking your risk capital divided by your potential maximum loss per trade. And in this case is $4,000 divided by 750. right? So you will work out to be 533 shares, and your trade value is around 43,706. And the second method is based on volatility. I use this a lot myself because I feel this is more dynamic. In this case, I'm using a 20-day average true range. The formula stays the same, except that in this case, you're free to determine what is the number of times average true range you want to use. For stocks that display low volatility, people typically use 2 to 3 times of its average true range. In this case, it's a 20-day. So that works out to be about 3.03. And for the calculation, it's the same. So 4,000 divided by 2 times of your ATR, and that works out to be 6,666 shares. And your trading value is $54,660. So these two methods give you different position sizing, but it's not too far away. Based on whichever method you use, it's to ensure that you're not having your position size without a method or without a formula for calculating what is the optimum trading size. You do not want to, based on gut feel, and just bet $100,000 on Apple. Even though Apple is quite an institutional stock, you still need to be consistent in applying all these techniques if you want to be successful in trading. So for more advanced traders, you may want to consider using the Kelly criterion, but of course, there's more labors to calculate, and it's only viable if, let's say, you have a lot of you keep records of all your trading statistics. That means you need to know exactly your historical winning probability and also your win-loss ratio. So without all this data, it's a bit harder to calculate. So let's not try something that's too fanciful and not useful, right? In fact, for most of the traders, these two methods are good enough. And this chart is basically just to share with everyone out there that I recently took on an investment position, right? And I used the same method to gauge my entry. Yeah, but if we would presume that this is a trade that you want to put on, right? So using all these methods, you can determine your price target, your stop loss way before that, and knowing where to take a trade, right? When you break out, you want to long that trade, and where is your price target based on, let's say, in this case, your previous resistance, which is roughly around 42.50, and this is a good trade if you can put it on, right? Yeah, so these are some of the illustrations that I can share with you, something I've done recently, except that I'm not trading this Pfizer. I'm actually investing for the longer term because it satisfies other criteria for my investment portfolio. I want to have exposure to Pfizer, specifically given its solid and robust fundamentals, and of course, it has long-term positive momentum. And in this particular slide, I want to share with everyone out there that not only you can use stop loss, in this case, your static stops or your trailing stops, to protect your individual positions. I want to highlight to everyone that you can also manage your risk effectively within your portfolio. That means all the outstanding positions you have put in place, that you can actually protect your overall portfolio by scaling back trading positions if your overall capital drops below a particular threshold. You can set it at 90%, 80%, or 70% for different individual needs. But this is a portfolio mechanism to make sure that you don't lose all your trading capital. Because on and off when you're trading, you have positions that make money, lose money, right? So you tend to lose track of your overall portfolio size or your portfolio capital. What happens is you are caught in individual gains or losses. You lose track, right, of your overall portfolio or what we call the equity curve, right? So in order to protect yourself, you can scale back trading or totally stop all trading if you hit certain threshold, right? A predetermined threshold. A good example is 20%, right? When your capital or your equity curve drops 80, your equity curve drops to 80% of your original starting capital, it is telling you you're trading very badly and it's time to stop. It's time to review and evaluate your outstanding positions. It's time to evaluate, are you trading on the right side of the market? Right? It's very likely you're trading on the wrong side of the market if your capital is down 20%. So you need to stop out yourself and get out of the market and cool down to review what you can do. Because psychologically, it can have very detrimental impact when you are not in the zone, you are not trading well, and that would even impact your trading portfolio. For all you know, you will do revenge trading, you will average down, you do all sorts of funny things to burn out your account. So word of advice, have some portfolio stops. In this case, I call it portfolio stops to protect your trading capital, right? So, oops, sorry, something is wrong with cursor. Okay. Right. So the key takeaway I want to share with everyone in this case is I'm sure all of you know who is this guy, right? This recent blow up by Bill Huang. It's very tragic if you ask me, because he spent the last 8 years trading his account up from $200 million to $10 billion. When you work that out, it's actually analyzing about 60% gains per annum, right? So this is very tragic because the track record that you build up, the gains that you build up over many years, you simply blow it up in a matter of days and weeks, right? But one of the hallmark I would like to remind traders, fellow traders, is he tends to have very concentrated positions, right? That means he hold usually nothing more than, say, 10 positions, maybe 8 to 10 positions, and he uses high leverage between 5 to 8 times. And what we do know from his recent blow up is he used a lot of, he used total return swaps. Total return swaps is basically a structured product offered by prime brokers. It's very common for institutional investors and some of the hedge fund out there to use total return swaps. I won't go into it, but these are structured products meant to give you exposure to the underlying, but you don't own the underlying, right? So some of the lessons that we should learn from Bill in this case is we need to learn from mistakes, right? Traders from time to time make mistakes, but apparently Mr. Huang is not learning from his mistakes, because back in year 2008, his fund was down 23% due to a short squeeze in the Volkswagen some years back, right? So Volkswagen experienced a short squeeze and he was on the short side. So he was heavily concentrated in Volkswagen and he got a short squeeze and his fund was down 23%. So in this case, you can see it's not easy to be down 23%, but if indeed you're down 23%, please step away from the markets, review and re-evaluate your exposure, your trading style, and ideally cut off from trading for a while, right? You're not going through a good patch. You're psychologically um, not right to trade, right? Because in order to be trading well, you need to be at the top of the game. Um, you need to be really sharp, right? You can't afford to be trading when you're not sharp, right? So the key to success in this case, it's knowing when to trade. If the markets are conducive, be aggressive. If the markets are not conducive, be defensive, or simply not trading, right? Or trade minimum. You have to know when to fight, when not to fight. Like in this current condition, um, most traders who are overweight on emerging markets are not likely going to be proud of themselves, right? For traders who are overweight on US, you got something to laugh at. And also, not just in terms of your market environment, because um, different market regions tends to move in different, I would say, in different pace, right? Some is stronger, some is weaker. So you have to choose. You have to be able to tell the relative strength between markets, between sectors, right? Which sectors to overweight. In this case, traders who over the last 3 months are overweight real estate, commercial services, healthcare, and technology is laughing at those who are very heavily exposed to financials, industrials, or materials. And of course, step two, key point number two is knowing when you're right. Please let your positions run a bit longer. Try not to take profits a bit too early because it is also one of the key problem with novice or young traders. They tend to take profits too fast, right? When you're right, let it move a bit longer before taking profits. And point number three is knowing when you're wrong. Please cut loss, move out from um, unfavorable positions, right? Scale out or move out of unfavorable trades. Cut it out so that you can channel resources to a better trade. So knowing when to get out and how to get out is very crucial to be a good trader. And successful trading, it's about having the discipline to trade with favorable probabilities. What I've shared with you earlier is to calculate and to prep where are the price target, the risk reward ratio, and doing all the prep work to mitigate your downside risk so that you can manage all these probabilities and ideally managing your own ego because you're trading well, you tend to feel better, right? So I would say you got to plan your trade and trade your plan, right? Although I repeat this many times, but it's something worth and ingraining inside your trading philosophy. You got to plan it. Do not trade randomly. Do not be like another Bill Huang, because good traders can lose it all. Right? Here's a good case study. He can lose it all if he don't practice proper risk management, and I do not wish that to happen to you. And with this, I wish everyone learn to time the markets well, because a trader needs to time the market. You need to learn to time it well, and not forgetting to practice good risk management so that you can stay game. And with this, back to you, Colin.
Thank you, Jake, for sharing so much insightful information with us. Those information are definitely helpful for the traders out there. Now let us move on to the Q&A section. Jake, could you help to go to the next slide, please?
Okay.
Yeah, to start off, the first question from our audience. Okay, is it okay to trade with higher risk of up to 5% if you are willing to take the extra risk for higher profits? What's your
I think
opinion?
it. I think it's absolutely fine, right? Like I said, everyone's situation or circumstances are different. If you think 5% is acceptable, I'm for it because um, mathematically it's very low that you will have 20 consecutive losses. 2% is quite conservative. A lot of people, they preach 2%. I would say whether it's 2%, 5%, I think you would need to exercise some discretion. 5%, I think is fine. Anything in excess of 10% or more, I think it's a bit too much because um, there is still a higher probability of you losing 10 consecutive times. So yeah, 5% I think is fine. As long as you decided on a number, you stick with the number.
Sure, thank you, Jake.
Yeah.
Moving on to the next question.
Mhm.
Based on your what was presented earlier, right? How much ammunition, in your words, do you think that the traders would need in order to stay in the game, or when they get margin calls?
Sorry, I didn't catch the earlier part.
Okay, how much,
Yeah.
I would say principal, okay, how much
Mhm.
capital, principal or capital, based on your illustration earlier, right? Do you think that traders would need in order to stay in the game, or when they are exposed to margin calls?
Okay.
I think,
Yeah, correct. In this case, when you mention margin calls, I would naturally assume leverage is used, right? Um, it depends
right,
on the, yeah, correct, the number of times of leverage applied on that, either that trade or your entire portfolio. Um, Usually for leverage positions, I would encourage people to, okay, let's just assume you have $100,000 trading capital. All of that 100,000 is deployed. That means you have positions using the $100,000 on leverage. Usually what I'll recommend people to do is you set aside 30% of your capital. That means you only use 70% of your capital to trade if you're applying leverage. You save that 30% capital for margin calls because sometimes um, even upon entry, you may be the markets will be against you for a while, right? So that 30% is able enough to fund for your entire portfolio if all your positions are, let's say, 5% against your entry, and you can still have enough to weather the storm. Yeah, so I would recommend at least 20 to 30% of your capital is set aside for margin calls. In this case, I am assuming you're using about 3 to 5 times leverage. Yeah,
sure,
correct. Yeah, of course, if you're using more leverage, you buffer more for margin calls.
right.
Yeah.
Okay, we hope we hope that we have answered the question. If not, right, we hope that the participants who post this question can may want to elaborate further. Right, so let's move on to the next question. One of the
Mhm.
participants actually asked, hold on to your dear life. Hold on to dear life. Okay, this kind of approach, right? Do you think it makes sense? Like the volatility will always be there, right, for the stock market. So what if, as a trader, they intend to hold out to in the hope that the price goes back up instead of cutting loss? So in your opinion, do you agree with this kind of approach, assuming that the trader is ready to hold on to the stomach the losses, the paper loss, and then also to hold out for a longer duration?
This is a classic. So I have to establish that we are trading, we are not investing. Um, let's say, oops, my desktop says my internet connection is a bit unstable. Okay, let's establish that this is for trading. Um, if you, in my opinion, trading is trading. It's not investing. Investing, it's a different ballgame, right? Of course, notwithstanding the fact that the investment position could be 20% down from my entry price, that is possible. But the reason why that happened is because the stock that you bought is getting cheap. It's getting cheaper in terms of valuations. So we have to bear in mind that most of the time there's a high negative correlation between momentum, right, short to medium term momentum with valuations. So in a nutshell, when the price is moving up, your valuation it's it's um, it's getting more expensive. So your valuation for stocks typically gets more expensive when the momentum is positive and when the valuations are cheap, right? Because investors would love to buy cheap stocks most of the time, or um, this is what intrigues a lot of people because I see a lot of interest in value investing. I would like to debunk value investing because it's not entirely accurate to call it value investing because value itself, when we measure against momentum, actually value it's higher volatility. So investors usually who love to do value investing would have to embrace more volatility because the stocks that they think is cheap will get cheaper. But for those stocks that are moving up tends to be positive because the market is pricing in growth, right? So usually when a stock that is growing, you get more expensive, your valuations get um, a bit higher than what you're used to. But those are natural part and parcel of how a stock moves because we have to treat stocks like a human being, right? When you are young, you tend to grow fast. And in this case, most of the stocks will go through the kind of life cycle. You'll find that a lot of stocks that are, or rather companies, right? At the back, behind all the names that you see in your quotes are actually companies. When we are investing in the company, but when we're trading, we are trading the momentum, right? Traders are only interested in price. If you're holding on to your dear life, I would consider you to be an investor who thinks that this company is something that you want to invest in, something that you believe in the story, something that you want to have it for the next 3, 5, 10 years down the road. And I would say I have no objections if you think that way. You are investing for the longer term. Price may decline 10, 20, 30% from your entry. I think it's fine, right? So it's a matter of mindset and your intention and your objective. Because
Right.
from time to time, yeah, we see investors after they make an entry and the price is still down 30%, they are convicted investors who believe that the stock it's going to work out, but that's not going to work for trading. If
Sure.
if you practice like that consistently for all your positions, you are very likely to see your capital being wiped out. Yeah,
Mm.
and that's
Thank you, Jay.
detrimental for your. Okay, yeah,
Yeah.
sorry, I think I went a bit too long on that.
Yeah, so
Yeah,
in summary, you have to define first what is your intention,
trading,
whether you are trading or are you investing, right? So
correct.
if you're
Yeah,
investing in a good company, of course, there's no harm to some if you can stomach the volatility. There's
that's right.
of course you can hold out the position. But if you are trading, then probably you might want to take a different approach, right? So in that regard, right, we do have a follow-up question here. So
Mhm.
so when the stock rally, right, let's say for 15%, okay, do you choose to take profit first or and then re-enter the market again, or would you continue to let it rally? How do you know that the stock has already reached the maximum point where the trader should take a profit?
This one is a golden question. A lot of yeah, a lot of traders would like to predict the exact turning point. I don't practice that. I don't usually advise that. Okay, usually when we are trading, you tend to have X number of positions open, right? So usually what I'll do is I look at which ones that are having the strongest relative momentum. If let's say I have 10 positions in my portfolio, based on your P&L, you can see which one is giving you the max. What I'll do is I will hold on to the names that give me a higher returns, even though it's paper gains. I will hold on and delay selling them compared to those who are, let's say, having a 10%, 20% gains as at a point in time, right? So I will usually trim those positions that is weaker, and I'll continue to hold on those to those that are stronger. Yes, although I shared with you that certain points that you may want to take some profits, it's nothing wrong with taking profits, especially if you're trading very big. If let's say your position is very small, I don't think it is going to be very impactful if you miss out on taking profits at certain levels. But if let's say your positions it's let's say 10% of your overall portfolio compared to 5% of your another position in your portfolio, I think the 10% one deserve a bit of trimming, if you ask me. Maybe you can trim it down to 5% of your portfolio. That means I'm still holding on to something, but I'm locking in profits. By taking profits, it's another way of so-called what we call the rebalancing, because you want to maintain certain balance in your portfolio. Yeah, correct.
Sure.
So, yeah.
Okay, so let's move on to the next question. Okay. Okay, so stocks in the same sector or industry often move in similar ways. Okay, so the question is it recommended to trade stock in the same industry, or would you suggest to diversify trades into other sectors?
Yeah, what you just mentioned is sector rotation. Sector rotation, yes, it happens all the time. In fact, before we go into sector rotation, I would like to also mention a little bit about geographical rotation. Those are the very minute changes that happens on the average every 5 to 10 years. The average number is about 7 years, 7 or 8 years, right? So, but those things happen very slowly, and sector rotation happens a bit faster. And if you ask me, traders should all be very savvy in tracking which sectors are stronger. In fact, this is I would say something that you die need to know, right? If you're not able to tell which sectors are relatively stronger, I would prefer you don't trade first. You get a feel of which sectors are moving, right? In this case, I would advise traders to diversify in two manners. First is to diversify across names in the same sector. In fact, usually what I'll do is I like to buy 3 to 5 names within the same sector. Yeah, that's usually what I do. So that's my style. I wouldn't want to bet on one name because I do not know how strong, because I recognize that I don't have the ability to predict. I can't tell you for sure Apple will definitely outperform Orange. So I will still pick amongst the relatively strong names, and I spread my bets around at least 3 to 5 names within the same sector. And I would diversify further by allocating to other sectors. That means I'll bet 3 to 5 names in other stronger sectors, right, relative to the weaker ones. So at any point in time, you can easily build a portfolio, let's say 3 names in 3 different sectors, and you have 9 positions, right? If let's say you are the super trader who loves to trade 20, 25 positions in your portfolio, why not? Because the more you are able to diversify, you not only spreading out your risk, but you're also spreading out potential gains, because I'm not spreading out. You're able to bet on certain names that you may miss out.
Sure.
Because more often than not, there are more than one name in the sector that will do well. So by betting 3 to 5 names, you are increasing your chances of not missing out on one particular name that could give you a 50%, gains over a 3 to 5 months period.
Sure.
Yeah.
Okay. In the interest of time, let us just pick two more questions. Okay, one question from the audience is, when you say that capital dropped by 90, 80 or 70%, right?
Yeah.
Then probably as a trader, you should stop trading. So how does it work if, let's say, you are doing a leverage product such as CFD?
It's the same.
Using CFD, okay.
It's the same because your trading capital is your trading capital, whether you apply leverage or not. When you are down 20% or 30%, you're left with 70% of your trading capital. And most of the time when traders in that situation, you will be very demoralized because you started off, let's say, with $100,000. You're left with 70,000, right? The only reason why you're losing that 30% is because you're on the wrong side. If you're on the wrong side and you can't figure out, it's better off you liquidate all positions and not trade until you figure out why you're on the wrong side. Because if you don't do that, you will continue to get you continue to get a very prolonged period of underperformance, and it's not a good way to. I would say it's not a good way to improve, right? Because if you don't chop it off, you don't save the capital, you don't protect it, you may end up being entrenched in losing positions, and you cannot even figure out why you're doing it wrong.
Yeah.
Yeah.
And also for CFD, because of the leveraging, you also magnify the losses, right? If let's say you are already in a losing position. Yeah.
Correct. Leverage is a double-edged sword. We have witnessed that with Bill Huang. You can make a lot of money, yes, right? 60% annualized is, I think, one of the record besides Renaissance Technologies. But the thing is, you don't get to keep it. It's all blown, no more. Right? It's gone, right? So you must have the ability to keep the money, and that is good risk management.
Okay, sure. Just one last question over here. Is there such thing as risk management or money management for longer term investment instead of trading? So if yes, right, what are the things to look out for?
Okay, it depends on whether you're a fundamental person or you're a technical person. For me, I'm a bit of both, right? Usually what I'll do is it's very easy for investors. It's very easy for investors to realize or ask themselves a question. For managing your risk, your downside risk, a classic example in Singapore, I would use its CIMB, Capital Corp, SIA, right, to be close to our hearts. These are household blue chip names. These are the names that we grew up with. These are the names that are associated with government. A lot of friends that I know, a lot of colleagues I know, they will simply tell me these are the names that won't go wrong. I don't deny that. The thing is, I have way back many years ago, I've already warned traders alike, investors alike, when Sembcorp Marine broke 380. Yeah, that was many years back. One of the reason is, one of the cue I took is a technical cue. That means I'm looking at the long-term trend and it starts breaking down. So that is part of my technical risk management, because prior to this, Sembcorp Marine was in a very long positive uptrend, but very choppy. But it starts breaking down. So that's a telltale sign for me that technically this blue chip company, it's not going to be it's not what it used to be. And fundamentally speaking, it starts to announce losses, right? And of course, it's losing money because of all it's a long story. All your oil rigs, nobody wants your oil rigs and stuff like that. Same thing goes for Capital Corp and SIA. The minute a company starts to report earnings, or rather a slowdown in earnings, or let's say a reversal, you start to experience a decline in earnings. So after a couple of quarters, you experience a full year down, and usually this is what kicks in. Institutional investors realize that and they will start offloading the stock. Even though it's a household name, but you have to understand that very fundamental changes in your earnings. For longer terms trend for investors, these are very crucial because earnings, your sales, your earnings, all these are your bloodline for your company growth. If a company stop growing in terms of your sales and your earnings, they will go into decline. And if they start reporting losses, and if they do not recover from losses, like in the case of Sembcorp Marine, Capital Corp is trying to do restructuring and stuff like that, and so is Sam Marine. But I would say Capital Corp is in a better position compared to Sam Marine. And for example, SI, they are trying to do a lot of things to save the company. Looking at the fundamentals, that's my personal opinion. I'm not quite optimistic on SI because of its ability to make money, profits, right? Profits, it's the key for investors, for company to stay alive. You need profits. The way it's burning cash, the way it's relying on bailout money, I am not hopeful as an investor. But because by virtue I have exposure to the STI ETF, and having exposure to SI, even though I don't like it, right? But what you can do is for your investment portfolio, if you're using any ETF, you have indirect exposure to companies or names that are not doing well. You can tilt away your portfolio by either shorting the name or buying more names that are doing well. Correct. So back to the question, investors will be able to tell the trend it's changing at all the technical cues when it starts going to a decline. It's telling you the fundamentals are changing. It's I would say deteriorating. It's getting from bad to worse. So those are telltale signs because the technicals always move ahead of fundamentals. And that indeed is true when we look at the changes in the technical side in terms of price momentum. It's telling you the very nature of these companies are changing. Fundamentally, they are not improving, they're deteriorating. And as an investor, I would say either get out or stop accumulating, right?
Sure.
If you love it, keep it, but don't buy more.
Yeah.
Yep.
Thank you, Jake, for
Thank you.
answering the questions. Okay, Jake, would you help to share the next slide, please?
Oh, sure.
Yeah.
Yep,
Okay,
I believe
so
you have an announcement.
yeah, so before we end the session here,
Yep.
this is an announcement. From now until 31st of December 2021, invest with us or trade with us to increase your chance of winning a Tesla Model 3. And not to forget, right, there's also monthly prizes of Apple products to be given away. And before you guys go, don't forget to follow us on our social media channels, Facebook, Instagram, LinkedIn, by simply scanning the QR code above. Yeah, Jake, could you move on to the next slide for the audience to scan the QR code? Yep. Okay, so last but not least, next slide, please. Yep. Last but not least, if you like some shopping vouchers, all you need to do, right, is to stay tuned in for all of our upcoming webinars and also to participate during the webinars. All right. You can do so by registering your slot by scanning the QR code that you see on screen. With that, we will end the session here. We hope that you enjoy today's session. Once again, we would like to thank Jake for speaking with us today, and all of you who have joined us in the webinar. Thank you for being such a great audience. We hope to see you again in our next webinar. Have a great night, everyone. Thank you.
Thank you, everyone.
Thank you, Jake.
Thank you, Colin.